Are inflation fears panic or hype? And what of the institution whose job it is to keep inflation in check? The countdown is on for a key meeting next week when a Fed committee will weigh inflation, growth, and the threat of new tariffs. But some of the drama is unfolding outside the meeting room. The Fed is under scrutiny from Congress for allegedly mismanaging a headquarters renovation, from a Treasury Secretary calling for a review of its effectiveness, and from the President himself calling for interest rate cuts. All of which has caused some to question, can the Fed fight inflation while preserving its independence? Joining us now is James Bullard, former St. Louis Fed president and a leading voice in monetary policy. He is now dean of the Mitch School of Business at Purdue University. Jim, welcome to the call.
Great to be here.
Jim, what are the prospects for growth and rate cuts this year?
I think that the committee will use the July meeting upcoming here to set up the September rate cut with a high probability. We'll see if that's exactly what happens. They'll keep a little bit of optionality around that. And then they'll look toward a possible further cut later in the year, probably at the December meeting. So you'd be about 50 basis points lower by the time you got to the end of the year.
So last week we had a CPI print that was 2.7%, a slight uptick from the month before. Is this a sign that inflation risks are still in the economy, or is it part of just an uptick and a long, slow decline from the peaks we reached at the end of the previous administration?
I don't know if you can read a lot into that particular report. I would say, generally speaking, inflation has been inching lower. And the committee likes to look at core PCE inflation. That's the less than food and energy measure. Or you could look at the Dallas Fed trim mean measure, which excludes some of the outliers. If you do that on a 12-month basis, you'll get a number around 2.5%. So still above target, but you'd like that to come down very slowly toward 2% over the forecast horizon. I think that's what they're looking for.
And what are the risks on the front? Now, Washington is negotiating trade deals with just about all of its major trade partners right now, and there is the expectation that at some level there's going to be tariff increases on imports. I just wonder what the risk is of that on the inflation picture going forward.
Yeah, tariffs are tax, and you'd be putting a one-time increase, tax increase on certain goods coming into the country. That's only a fraction of the total number of goods that are consumed by American households. So because of the small fraction and the exemptions and other things, I think most estimates are that this would only have a few tenths impact on the inflation rate. Now, you can go other directions on that. Those would be one-time changes, so that later those, since it's just a jump up, it does not continue into the future. The other thing that people have worried about is, well, maybe that would create an inflation mindset in the U.S. and create higher expected inflation. And expected inflation is actually a very powerful variable. But so far, what we've seen from the TIPS market, the market-based inflation expectations, is that they seem to be pretty low in this circumstance. So I don't think we're looking at a situation where inflation expectations are going to drive future inflation either. And so I don't think we're going to see too much inflation out of this.
Jim, I'm putting up a chart here that I think speaks directly to one of the challenges the Fed faces today. What you're looking at is University of Michigan's long-run inflation expectations broken down by political affiliation. Now notice the dramatic split. Over the next 5 years, Democrats and independents see inflation running above 5%, while Republicans expect something closer to 2%. Now, public expectations, as you mentioned, play a role in monetary policy. So when we are this polarized, how does the Fed maintain credibility across the political spectrum?
Yeah, I think this shows that the University of Michigan survey is losing credibility because people have discovered that inflation is a major variable in politics. I think it probably cost the Democrats the election in this past round here. And so they're assigning probabilities for inflation to the other party and the other party's policies, and that's making it less reliable to us macroeconomists as a true read on what you think inflation is going to be in the future. I mean, it's not all terrible because in many countries around the world, inflation is associated with governmental disarray. And to the extent that you're partisan on one side or the other, you either think we finally got sanity or we've gone completely insane. And so that might affect your inflation forecast. But from a macroeconomist point of view, I think it's probably better here to look at the tips market where you've got real money on the line. And do you really want to bet on 6% inflation over the next 5 years? If you do, you can. And if you're right, you'd make a lot of money right now. But I want to see you put your actual dollars behind that kind of bet.
Okay, this comes at a time when a lot of pressure is mounting on the Fed to lower rates, particularly from the current administration and supporters in Congress. How do you lower rates without looking like you're capitulating to political pressure?
Well, I think the committee has been consistent in saying that they wanted to recalibrate the policy rate. They moved the policy rate down 100 basis points last year. And some of those effects are coming into play even right now for the economy. Then they went on pause earlier this year because of tariff uncertainty. But now that you're a little farther along in the trade war, I think they feel more and because inflation has come in relatively benign, I think they feel more comfortable in going ahead and lowering the policy rate. So I actually think they're on pretty good track here for the second half of 2025.
Now, the president in particular has been demanding that the Fed lower rates, in part for lowering the servicing costs. And to be fair, he isn't the first to try to jawbone the Fed into lowering rates. Presidents Truman, Johnson, Nixon, Reagan all tried to influence monetary policy from the bully pulpit. Add to that members of Congress or even foreign leaders, and clearly the Fed has been fair game for commentary, whether mild or harsh. My question for you, Jim, is this. When the political noise gets this loud, what's it like inside the room at the FOMC?
It's a very data-intensive organization. It's a formal meeting. You have a 19-member committee. All of them have strong opinions. The presidents have their own, the reserve banks have their own staffs and their own analysis, which they will bring to the meeting. So it's really a pretty intense affair, and I think the members take their role very seriously. We get, all the time I was on the committee, you're always getting advice from all over the place, which I kind of love in a way, because I do want to hear people's opinions about monetary policy and how well the committee is doing. But it's nothing new, as you point out, and this is something that the committee is very good at navigating.
Now, the president has a point in that debt servicing costs now are greater than what we spend on defense. There have been many political historians who say that when a great power gets to this position, it's often a very quick way not to be a great power for much longer. Is that a concern of the Fed, or is that more a concern of Congress?
Yeah, I mean, Congress has decided, and previous Congresses have decided, in both parties, I think, to kind of abandon fiscal discipline that was once a hallmark of at least a cadre of members of Congress. You really don't see that today. And I think all sides have decided that the best political strategy to keep getting elected is to keep spending and run big deficits. So unfortunately, we're in a bad position there. I don't think the Fed can really do anything about that. Even if you thought borrowing costs were a little bit lower, Congress would just rush in and fund a new bridge or fund a new expensive program. So I think that the problem is really a spending problem that Congress refuses to address, and really is a fundamental problem for the country.
Now, the Wall Street Journal came out earlier this week saying that the economy is quite strong and that we're starting to see some swagger coming back into U.S. Policy firmament here. Why would you lower interest rates when the economy seems to be doing pretty well given all of the uncertainties out there?
It is doing well, I would say, but the policy rate was set a little bit higher because inflation hadn't gone away completely, and it has come down a little bit further since then. So now the committee has a little bit of room to move toward the more neutral rate, and some members on the committee have that as low as 3%. So it really got some basis points to work with here. I would say with the unemployment rate near the natural rate of unemployment and inflation closing in on the inflation target, you would expect that the policy rate would be right at whatever the committee thought the neutral rate was. And so that's why they've got room to maneuver, even though, yeah, the stock market at an all-time high and many businesses reporting great profits in the recent earnings season.
So one of our members is asking, as a source of inflation, how do tariffs compare with excessive growth in money supply or fiscal spending?
They pale in comparison, be a very small effect. As I was saying before, we are a big open economy, but still it's only a small fraction of all the goods and services that's actually coming in over the border. And so, you know, and if you change the tariff there, competition doesn't go away, as many in this audience would be well aware of. You still have to sell the product to the final consumer, and there are other goods ready and sitting on the shelf, you know, ready to be the substitute for the higher price. So that I think that the debate has gotten better here. I think initially the idea was just, oh my God, the tariff just gets passed straight through, and then everyone just buys just as much as they did before at this higher price. But that can't be true. If you could just charge 50% more for your product, you would have done that before any talk of tariffs or anything. Everything's already competitively priced. And so somehow you have to get the incidence of a tax to somehow get you know, distributed through the supply chain.
Now, if you review the transcripts of your time at the Fed, there were times when you were ahead of the pack in pushing for higher rates. There are other times when you were also ahead of the pack pushing for lower rates. And I'm thinking specifically about 2019. You had a time when we had trade tensions with China. You had economic uncertainty. There's a lot of similarities between that time. Scale is different, but between that time and today. And I'm just wondering, how does that compare with this current moment? Do you see any similarities between 2019 and today?
Yeah, I've been advising audiences that the 2018-2019 trade war is a good playbook to study for the current situation. And in that situation, especially was a heavy trade war with China. This time it looks like China's a little bit more on the back burner than they were then, but obviously a major trading partner. What happened was that inflation actually fell, core PCE inflation actually fell during the first half of 2019, and the global economy slowed down because of the feud between China and the United States. And by the time you got to the summer, the committee was ready to recognize that and lowered the policy rate somewhat at that time. At the time I dissented. I think I wanted them to move in June, and they didn't want to go till July, which is always something that drives me a little bit crazy. I won't move today, but for sure I'll move next time. So I dissented on that one. But generally speaking, yeah, I wanted lower rates to address the trade war. And by the time we got to the end of 2019, I think we were in real good shape. And then coming into 2020, of course, COVID came in and completely changed the picture at that point.
Jim, I wanted to ask you a couple of questions about Fed independence. My former colleague at the Journal, Greg Ip, wrote earlier this week, if the markets are any judge, it seems there is still faith in the Fed acting independently and doing what's right. If you remove the Fed chair before his term is up, would that undermine that faith?
I think it would, and I think markets would start to worry and price in an inflation risk premium that isn't there today. And I think that would be problematic even from the administration's point of view, because that would mean higher medium-term and long-term rates, and they're trying to get lower rates. So there's no reason to have that inflation risk premium in there. And you can see countries that don't have independent central banks, they really have to contend with the fact that markets want to be compensated if they're going to be uncertain about the future inflation policy of the country. So I do think it would be problematic from that perspective.
There's also been a move in Congress to bring attention to cost overruns in a renovation project for the Fed's headquarters building. I'm wondering what you make of that. Is this something that we should be focused on, or is this just some noise on the sidelines that really isn't going to impact policy in the weeks and months ahead?
Yeah, I wasn't directly involved in that, but they picked up that extra building on the mall. The Fed has been renting building, as I understood it, for years in Washington, D.C., one of the most expensive property markets. So I think the initial thought was partly that they could help restore this historic building and they could get out of that rental and get into their own property. So that was the original idea. I think the best laid plans, though, they all go awry. They had asbestos, they had the water table issue, they had other things. So it's really ballooned the expenses, unfortunately.
All right, another criticism of the Fed has been this tendency here in Washington to make comparisons between the rate of interest here in the United States and other countries. Is there any value in such a comparison, or is that like judging a doctor based on how many painkillers the doctor hands out?
Yeah, I think many of the other countries are much more worried about recession at home and their home country than we are here currently in the United States, and so that's probably driving rates down in those countries. That's not good news if you're hanging out there, but. So really, I think the interest rate structure that the United States has right now, to me, looks very healthy. You've got an upward sloping yield curve. You've got a pretty positive outlook for the economy. I do think the deregulation agenda will be good for the U.S. economy. I think this is absolutely a pro-business sort of administration. And so I think we can look forward to continued growth and a continued healthy credit market.
So is this sort of golden age when we have high growth and low inflation something that's attainable, do you think, in our not too distant future?
I do think it is. My model is the late 1990s, which is one of my favorite eras in U.S. macroeconomic history. You had rapid growth for several years in a row. That helped a lot with the fiscal deficit at the time. And we had low inflation and we had low unemployment, eventually about 3.8% by the time we got to 2000. And of course, a lot of things happened after that, but that was a very good run for the US economy. And I think there's no reason why we can't repeat something like that. Fast growth, good labor market, low inflation, and maybe the faster growth will help us a little bit on the fiscal deficits as well.
Well, hopefully our best days are yet to come. Last question for you, Jim. As the Dean of Purdue's Business School, what are you telling your graduate students about the current economic environment?
We think our students have a great chance of success, and they do get great placements. Purdue is the most recruited campus in America. And it's what we're doing is combining technology and business together. A lot of business schools will talk about that, but we've got the credibility on it with outstanding engineering here at Purdue. So we think our students will be very successful going forward.
So you think this is a good moment to have a business degree in the current economy?
I think if you're combining it with a technical knowledge that's valuable to the business, there's no telling how far you can go.
All right. Well, there's a gazillion other questions I would have liked to have asked you today, but we'll have to leave it there. James Bullard, former St. Louis Fed president, and now at Purdue. Thank you so much for being with us on the call today.
Great. Thank you for having me.
All right, our audience has gotten their shot of informational espresso and is ready to tackle the rest of the day. Missed a live episode? Catch the replay on our website, LinkedIn, or on YouTube. You can also listen to the Call's podcast edition on Apple, Spotify, or wherever you get your podcasts. This has been The Call, brought to you by the Global Intelligence Desk, asking the right questions to navigate uncertain times.